What is up, everyone? Welcome back to Finance Sphere. Look, there's an old saying on Wall Street: sell in May and go away. The idea is simple: risk assets usually lose steam starting in June, so you're better off cashing out in May and sitting comfortably on the sidelines. But does this playbook actually apply to the crypto market? Now, obviously, crypto isn't always tethered in lockstep to legacy equities. But at least for this past June, that old adage hit uncomfortably close to home, with scary precision. In fact, what I saw in June was an absolute bloodbath. As Bitcoin lost its footing and started to wobble, the entire market got slaughtered, especially across altcoins, which took a massive, soul crushing beating from overextended downside moves. Right now, a ton of investors are just completely exhausted, panicked, and straight up throwing in the towel. On top of that, looking at the macro picture, 2026 was always statistically set up to be a brutal year. According to Bitcoin's historic 4 year cycle, we are currently stuck in that post halving phase, the exact phase where the market carves out a massive cyclical peak and triggers heavy structural selling pressure and deep, painful corrections. So, after the massive flushing I just witnessed in June, what does the rest of Q3 2026 actually look like? Is the market just going to keep sliding into a total free fall? Or is there a stealth reversal setup silently sitting on the table? Let's just cut straight to the chase. When you look at July seasonality, the data for risk assets, including crypto, is heavily skewed toward a green month, not a red one. Once we drag ourselves out of a hellish June, July historically prints a massive relief rally. Bitcoin and the broader crypto market aggressively claw back those previous losses. And here is the kicker: this July crypto pump doesn't happen in a vacuum. It's tightly, deeply correlated with a broader, macro driven risk on environment across the entire global market. Just look at the historical data for the S&P 500, the ultimate pulse of the US stock market. Amazingly, between June 26th and July 15th, the S&P 500 has historically closed green for an incredible 25 consecutive times during this exact window, averaging a solid 3.33% gain. I usually see a leg up from early to mid-July, before that momentum starts fizzling out and rolling over toward the end of the month. In other words, looking at Q3 as a whole, the data points to a highly volatile, two-sided tape: an aggressive rally early on, followed by a sharp drop on the back end. So, what's the actual plumbing behind this early July pump? It all comes down to the raw money mechanics of the legacy markets. The biggest catalyst? Q2 earnings season. This is when the heavy hitters dominating the global narrative, big tech, platform giants, and AI plays, all drop their Q2 report cards. Statistically, these companies have a rock solid track record of beating or meeting Wall Street expectations in Q2. That drives an expansion in valuation multiples, dragging the entire market up with them. The narrative is simple: earnings beat, buy stocks, and that attracts massive capital inflows. To add fuel to the fire, you have institutional rebalancing. The big money, hedge funds, and asset managers running global portfolios execute two major rounds of position adjustments around January and July. They hunt for high quality, fundamentally sound assets that got completely oversold or beaten down during the first half of the year. And they deploy massive bottom fishing capital to maximize their H2 performance. As a result, smart money starts rotating into the exact assets that were left for dead in June, sparking a major bid, and that macro liquidity tailwind trickles right down to crypto, which sits furthest out on the risk curve. When traditional finance gets a facelift from corporate earnings and institutional flows, it triggers a powerful bounce signal for a crypto market that spent all of June curled up in fear. If you look at internal crypto on chain metrics and statistics, this seasonal trend is even more obvious. Historically, July has been a highly reliable, high probability green month for Bitcoin. But the real alpha here is that this July relief rally packs a way more explosive punch in the altcoin market than it does in Bitcoin. When I extract and analyze data from the past 5 years, the altcoin market has a history of printing absolute face melting gains in July, boasting an average monthly return of around 20%. Whales and smart money basically step in to completely absorb the panic selling from retail at the June bottoms and aggressively squeeze shorts on the way up. And right at the center of that explosive rotation, you always find the mega cap majors leading the charge, Ethereum and Ripple XRP. Historically, whenever July rolls around, these two assets put on a clinic. Let's verify this structure directly on the charts. What you're looking at on the screen right now is the ETH-BTC pair, tracking Ethereum's value relative to Bitcoin. Right now, Ethereum is putting in aggressive breakout attempts, trying to pierce above a heavy structural resistance line that has suppressed it for months. At the same time, look at Bitcoin dominance versus Ethereum dominance. You can see that Bitcoin dominance is topping out and losing steam at local highs, while ETH dominance is carving out a solid bottom and curling upward. The combination of these two charts tells a very clear story. This is a classic textbook setup for an alt rotation. And if I see any major regulatory breakthroughs or guidelines surrounding the Clarity Act this July, that narrative could act as an absolute powder keg for a massive rally that completely defies expectations. But look, the absolute biggest trap in this game is getting blinded by the green candles and ignoring the risk on the horizon, right when it feels like the July pump will last forever. Macro markets have a habit of turning ice cold. Historical data shows that the wheels start coming off in late July. August and September are structurally the weakest, most brutal months of the year for risk assets, consistently posting miserable returns. Why? First, it's a classic sell the news event. Once the corporate earnings hype dies down and institutions finish front loading their H2 rebalancing capital, the buying momentum completely dries up. When a market runs out of fresh narratives, players start taking profits and distribution takes over. But the real tail risk here is much more sinister. August is historically an absolute monster of a month for Treasury issuance and debt sales. The supply hitting the market is massive, heavily clustered around the second and fourth weeks. The Treasury has an explicit target to ramp up the TGA, the Treasury General Account, to a staggering $950 billion by the end of Q3. Think about what that actually means. The government is basically vacuuming up $950 billion in cash from the private sector via bond issuance and locking it away in their vault. In a liquidity-driven market like crypto, when that dollar liquidity dries up mid-quarter, it creates an aggressive, brutal headwind for all risk assets. To make matters worse, there is one more critical risk variable I absolutely cannot ignore: the Kevin Warsh effect. The new Fed chair just wrapped up his debut FOMC meeting in June. The market was completely hyper-focused on his tone, and the consensus came back pretty hawkish, signaling tighter monetary policy. Historically, there's a distinct 2-month lag after a new Fed chair's debut. It takes the market about 60 days to truly digest their policy stance, stress test their credibility, and price in the uncertainty. Statistically, this discovery phase almost always culminates in a sharp correction for risk assets exactly 2 months post-meeting. Since Warsh debuted in June, that 2-month countdown hits a critical mass right between August and September. So, at the exact moment the Treasury is dropping a massive liquidity bomb on the market, I'm also slamming face first into peak policy uncertainty and disappointment surrounding the Fed. This means I need to be on high alert for massive volatility surrounding the late July FOMC and the late August Jackson Hole Symposium. Risk management here is non-negotiable. Another macro puzzle piece to consider is the election cycle. Generally speaking, The sixth year of a US presidential cycle tends to deliver pretty decent full year returns for risk assets. But if you break down the seasonal charts precisely, a chilling commonality emerges. No matter how strong the macro annual return is, the interval between August and September unfailingly triggers a sharp price drop or a deep correction. Even though crypto doesn't always trade in lockstep with equities, it is entirely dependent on liquidity, the absolute lifeblood of these markets. And the final destination of all these macro headwinds converges cleanly with Bitcoin's historical framework, the 4-year cycle. Historically, post-halving peaks lead to a grueling 12 to 13-month structural downtrend before finding a generational bottom. If I map out this cycle's macro top around October 2025, the math points to a potential cyclical bottom forming right between late September and early October 2026. Think about how incredible that is. The peak timing of liquidity exhaustion and Fed risk in August and September, dictated by the macroeconomy, and the expiration timing of the decline formula, indicated by the internal crypto 4-year cycle, are converging onto a single temporal coordinate, late September 2026. The dark bear market coming in August and September is not a herald of doom to be feared, but is highly likely to be the last, most attractive bottom fishing opportunity presented to us before transitioning into a macro bull market on the 4-year cycle. To wrap it all up, July shows strong potential for a short-term, altcoin-driven bounce of around 20%, fueled by corporate earnings, institutional rebalancing, and a relief rally from June's oversold conditions. Instead of FOMOing into the green candles, a prudent strategy to consider could be locking in some short-term profits and building a cash position. August and September are likely to face notable downside pressure as the Treasury is projected to pull $950 billion out of the system, which could couple with the new Fed chair's policy lag risk and historical election cycle corrections. Keeping your guard up around the July FOMC and late August Jackson Hole seems highly advisable. Finally, by late September to mid-October, much of the macro pain could be priced in, and Bitcoin's 12 to 13-month post-peak correction window approaches its historical expiration. This confluence of factors could mark the tail end of Q3's volatility, potentially presenting a highly attractive buying opportunity. Look, in this market, expecting a 100% guaranteed direction is simply unrealistic. Nobody has a crystal ball. Nobody has a crystal ball. The key to surviving and building real wealth isn't reacting to the daily noise and panic. It's calmly studying historical data, analyzing monthly trends, and positioning yourself where the probabilities appear heavily in your favor. That is what I consider smart investing. That's all for today's data-driven Q3 macro outlook. In a choppy, high volatility environment like this, I hope this deep dive offers a clear framework for the second half of the year. If you got value from this video, do me a favor. Smash the like button, hit subscribe, and turn on notifications so you never miss an update. I'll catch you guys in the next video. Peace.